Deckers just recorded an absolute blowout first quarter, yet the stock completely cratered. We're talking a double-digit plunge in a single day. So what happened? The underlying business looks stronger than ever, but Wall Street just slammed the panic button. In this explainer, we're going to uncover exactly why the market punished a perfect quarter, what the underlying financial realities actually are, and figure out if this massive disconnect is a huge warning sign or literally the entry point long-term investors have been waiting for. 13.6%. That is the number that caught absolutely everyone off guard. Following their Q1 fiscal year 2027 earnings release on July 23, 2026, Deckers closed regular trading down over 6%, and then it just kept falling, plummeting an additional 8% in after hours. That is a violently aggressive repricing for a company that has been an absolute darling of the consumer discretionary sector. I mean, we're talking about a stock with a 10-year total return of over 1,200%. A drop of this magnitude immediately tells us that investors aren't just tweaking their spreadsheets, they are genuinely spooked about a fundamental shift in the company's future. But here's where the tension really kicks in. If you only looked at the fundamental performance for the quarter ending June 30, 2026, you'd think the stock was going to the moon. For what is historically a seasonally small quarter for them, Deckers delivered its first ever Q1 revenue above $1 billion. They hit $1.02 billion in net sales, which is up 5.7% year over year. And their gross margin didn't just hold up. It expanded by 60 basis points to a super healthy 56.4%, blowing right past the analyst consensus of 54.4%. Bottom line, diluted earnings per share came in at 94 cents, totally crushing estimates of 87 to 88 cents. They even raised their full-year EPS guidance. So they are generating more cash at higher margins than Wall Street thought possible. Which brings us right to the central question we have to answer. Why on earth did the market punish a perfect quarter? To understand the fear driving this massive sell-off, we first have to understand the concrete economic engine that makes Deckers so valuable. You really can't understand the risk until you understand the moat. Section 1, the twin growth engines. Okay, let's dive into this, because the Deckers of today is not the same company it was 10 years ago. They have fundamentally transitioned from a seasonal, kind of niche-focused portfolio into a highly consolidated, ruthlessly efficient brand house. Back in August 2024, they actually finalized the divestiture of their underperforming action sports brand, Sanuk, selling it to Lolé Brands. This wasn't just housekeeping. It was a loud strategic declaration that they are funneling all enterprise resources into their two undeniable megastars. The entire company now relies on a massive dual-engine architecture. On one side, you've got HOKA. Originally built as this maximalist, heavily cushioned running shoe for hardcore ultramarathoners, HOKA has rapidly expanded its addressable market into walking, trail hiking, and just everyday lifestyle wear. They own proprietary tech, oversized midsoles, meta-rocker geometries, active foot frames, stuff that competitors simply cannot legally replicate. And on the flip side, you have UGG. Historically, UGG was totally trapped in that highly seasonal winter boots cycle. But management successfully broke them out of that box by aggressively expanding into sandals, mules, plush slides, and men's styles, which actually now account for 15% of the brand's revenue. UGG has evolved into a year-round premium lifestyle juggernaut. When you look at their fiscal year 2026 consolidated sales of $5.47 billion, the dominance of these two brands is just striking. UGG generated 50.1% of total revenue, and HOKA brought in 47.3%. Everything else in their portfolio, including Teva sports sandals and the value brand Koolaburra, makes up just 2.6%. This hyper-tight focus is a massive advantage. It means all their marketing dollars, supply chain optimizations, and retail expansions are laser-focused on the highest return assets. And man, it is working globally. While U.S. domestic sales make up roughly 58% of revenue, international sales grew an incredible 26.8% in fiscal 2026. And this perfectly highlights the raw power of their brand equity. Their trailing 12-month gross profit margin sits at an elite 57.7%. In the cutthroat footwear industry, a margin pushing 60% is the ultimate proof of a competitive moat. It basically means consumers are yanking the product off the shelves at full price, without Deckers having to resort to margin-crushing promotional discounts. Just to put that in perspective, Nike is still the volume leader with roughly a quarter of the global running market, but they're fighting serious margin compression right now. On Holding, a key premium competitor operates with a slightly higher gross margin at 62.8%, but Deckers operates at a vastly larger scale. Deckers protects this margin and their moat through incredibly strict marketplace management, limiting wholesale inventories strictly to premium partners to prevent oversaturation. Section 2. What spooked the market? So, we've got an elite brand house operating at near 60% gross margins, growing internationally and just crushing earnings estimates. What could possibly go wrong? Well, beneath the surface of that Q1 earnings call, management dropped some commentary that completely altered the market's risk models. Now, what's really interesting here is it exposes Deckers' absolute biggest hidden vulnerability: geographic concentration. The company relies heavily on manufacturing facilities in Vietnam. While a unique 2025 trade policy kept Chinese footwear tariffs at 0% through late 2026, the broader geopolitical landscape in Southeast Asia is shifting fast. Recent trade adjustments project that a 20% tariff on Vietnamese footwear could increase Deckers' cost of goods sold by $150 to $200 million. By voluntarily increasing their go-forward tariff rate assumption from 10% up to 12.5%, management essentially told institutional investors that these geopolitical costs are no longer theoretical. They're actively bleeding into the forward-looking models right now. And this triggered a rapid formulation of the bear case, which is basically a three-headed monster. First, those permanent tariff hikes threaten to lower their pristine gross margins for good. Second, ongoing shipping disruptions in the Red Sea are causing massive spikes in ocean spot freight rates and extending delivery times, which management explicitly warned would pressure margins in the second half of the year. And third, management cautioned that a chunk of their Q1 wholesale revenue growth was actually just a timing pull forward of shipments, not a sudden massive surge in consumer demand. Wall Street absolutely hates uncertainty, and these three factors dumped a massive cloud of it over the second half of the year. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. Section 3. The Quality Scorecard. To truly evaluate if the market overreacted, we need to step back from the immediate news cycle and run the company through a rigorous qualitative analysis. Let's look at the structural health of the business to see if it can actually withstand these supply chain shocks. And the reality is, Deckers has an absolute fortress of a balance sheet. They're sitting on $1.603 billion in cash and equivalents. But more importantly, they have zero outstanding debt. Let that sink in for a second. Zero debt. In an environment where logistics costs are skyrocketing, having no interest expense and a $1.6 billion cash cushion is the ultimate strategic luxury. On top of that, they generate a 41% return on equity. When synthesizing factors like management alignment, where new CEO Stefano Caroti holds a solid stake and performance units are tied to operating margins, along with incredibly high revenue quality driven by full-price sell-through, the business earns a blended quality score of 8.6 out of 10. The only major knock against them is that business viability score, and that is strictly due to that Asian manufacturing concentration we just talked about. All the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free, at flash.sentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years, hidden gems, under-the-radar names with asymmetric upside, and dividend hunters, durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes. Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.sentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Let's get back to the models. Section 4. 3 future scenarios. Let's see how all this builds into our 5-year scenario analysis. To understand where the stock might go by fiscal year 2031, we need to model out the operational realities of the business. Now, before we dive into the numbers, please note, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. These models are anchored to the baseline stock price of $96.23 from the regular market close on July 23rd. We assign a 55% probability to the base case. This scenario assumes the business normalizes from its post-pandemic hypergrowth. We project an 8% compound annual growth rate for revenue over the next 5 years. We assume they successfully use their channel mix to offset near-term tariff pressures, maintaining a target operating margin of 21.5%. Crucially, because of their massive free cash flow, we model a 2% annual reduction in outstanding shares through buybacks. By year 5, this translates to over $8 billion in revenue, roughly $1.3 billion in net income, and a diluted EPS of $10.60.
Applying a mature global brand exit PE multiple of 16 times, meaning the market values them at 16 times their earnings, we arrive at a projected share price of $169.59. That's a 76% total return, or about 12% annualized.
Then there's the bull case, which we give a 25% probability. This relies on exceptional execution of their international strategy. Management plans to open 25 HOKA retail stores annually, heavily targeting high-growth markets in China. If HOKA rapidly scales internationally and UGG continues expanding its men's categories, we project a 12% revenue CAGR. Favorable pricing pushes operating margins up to 23.5%, and that higher cash flow allows them to retire 3% of their shares annually. In this scenario, year 5 EPS jumps to $14.64. With stronger growth, they command a premium 20 times multiple, yielding a target of $292.72. That is a massive 204% total return, or nearly 25% annualized.
But we absolutely must address the bear case, assigned a 20% probability. This is where the market's current fears actually materialize. HOKA experiences brand fatigue in the US, UGG's lifestyle extensions stall out, and high ocean freight and tariffs permanently compress those margins. Revenue growth drops to a sluggish 3% CAGR. Operating margin contracts heavily down to 17% as they're forced into promotional discounting to move product. Share repurchases slowed to just 1% annually. EPS falls to $6.29, and the market slashes their multiple down to 12 times. This results in a share price of $75.45, an annualized loss of nearly 5%. When you synthesize these three scenarios using probability weighting, so that's 55% base, 25% high, and 20% low, we calculate a weighted price target of $181.54. This models a potential 88% total return from the current baseline price. What this chart clearly shows us is a highly asymmetric risk-reward profile. The downside risk modeled in the low case is roughly a 21% decline, while the upside in the base and high cases offer substantially larger returns. It strongly suggests that at current valuations, the market has already priced in a significant amount of the supply chain pessimism. And remember, you can get the full detailed model with all the underlying assumptions completely free at flash.stocksentinel.ai. Section 5, Risks and Final Verdict. But before we declare this a perfect setup, we need to transition into our final risk analysis, because a strong model is totally meaningless if a foundational risk breaks the thesis entirely. So what are the early warning signs investors actually need to watch for? Well, the true long-term threat isn't a temporary spike in ocean freight. It's that structural concentration in Vietnam. If trade policy permanently adjusts tariff rates above 15%, that permanently damages the margin profile. An early warning sign here would be gross margins slipping below 55% in upcoming quarters. Second is HOKA's execution risk. Athletic footwear is famously fickle, right? Maintaining brand heat as they transition from hardcore running into casual lifestyle wear is incredibly difficult. If you see DTC comparable sales growth decelerate below 5% or inventory piling up at wholesale partners, that's a huge red flag. Finally, they face intense, highly focused competition. On Holding is growing rapidly with premium margins, and Birkenstock totally dominates the orthopedic comfort space. Deckers cannot afford to lose retail shelf space to these highly specialized competitors. So, the crucial point is how management defends against these risks. And their primary weapon is capital allocation. While the market panicked over near-term logistics and tariffs, management was sitting on a massive $4.7 billion remaining share buyback authorization. In Q1 alone, they repurchased over $338 million in shares. Listen, when a company has zero debt, massive free cash flow, and a multi-billion-dollar buyback cannon, market sell-offs actually become highly accretive to long-term shareholders. Why? Because the company can retire a larger percentage of outstanding shares at a discount, artificially boosting future earnings per share. Which brings us all the way back to our opening question. Is this a broken thesis or the ultimate entry point? Let's quickly recap the three most important takeaways. First, HOKA's international expansion and planned retail footprint in China provides a massive multi-year growth runway. Second, UGG has successfully shattered its seasonal dependence, creating year-round demand with phenomenal pricing power. And third, the company's elite balance sheet and capital return discipline offer a huge margin of safety against macroeconomic shocks. Yes, the technical breakdown below the 200-day moving average looks ugly, and the near-term tariff noise is very real. But the market appears to be heavily overweighting temporary logistics pressure while severely discounting the durability of a 60% gross margin brand house with zero debt. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.